You'll hear plenty of ambitious numbers in investing. People who say they'd be happy making 20, 30, even 35% a year. The truth is less glamorous but more useful. Markets go up and down, and while some years deliver big gains, other years deliver disappointments. If you insist on expecting 25 or 30% every year, you're setting yourself up for frustration and for taking unnecessary risks. A far more realistic benchmark is the long-term market return, roughly 9 to 10% a year. If you pick your own stocks, your goal should be to beat that by a meaningful margin. Lynch suggests targeting about 12 to 15% a year after costs. That might sound modest compared to the hot talk on TV, but compounded over decades, it makes a huge difference. One reason to be realistic is cost. Trading costs and fees matter. Even with lower commissions than in the past, frequent buying and selling eats into your returns. If you trade too often, you can easily give away 3 or 4 percentage points just in commissions and slippage. That means a trader who turns over the portfolio a lot has to be that much better at selecting winners just to break even with a simple index fund. If your active stock picking doesn't clearly outperform the S&P 500 after costs and taxes, you should either change your approach or consider a low-cost indexed alternative. So, how many stocks should you own? There's no mystical number. The right number is how many opportunities you really understand and can follow. Lynch's practical view is simple. Own as many companies as there are good ideas where you have an edge. For many individual investors, that translates into a modest, focused portfolio. Say 3 to 10 well-researched stocks. With a handful of strong ideas, you get concentration and the chance that one of them will become a big winner. Lynch points to surprises like Stop & Shop, Marriott, and Taco Bell, companies that turned out to be far more profitable than anyone initially expected. By owning several promising names, you increase the chances that one becomes a 10-bagger. At the same time, don't confuse diversification for its own sake with intelligent spreading of risk. Lynch warns against owning hundreds or even thousands of random stocks. That kind of foolish diversity merely dilutes your best ideas. But neither is it wise to put everything into one name unless you truly understand the company and can tolerate the consequences. If you must pick just a few positions, pick ones where your homework gives you confidence. A helpful way to design a portfolio is to spread your money across categories: stalwarts, cyclicals, fast growers, turnarounds, asset plays, rather than only across random sectors. Each category behaves differently in different markets. Stalwarts and slow growers tend to provide ballast in bad years. Fast growers and turnarounds can be the sources of explosive gains. Lynch himself kept a balanced approach. Some stalwarts, some cyclicals, and plenty of opportunities in growth and turnaround situations rotated as conditions changed. Your allocation should reflect your age, risk tolerance, and how much time you'll spend researching. Younger investors can favor growth and higher risk. Older investors should give more weight to income and capital preservation. Rotation is an essential habit. Don't be married to a stock just because it has gone up. Rotate out when the story no longer supports further gains. Likewise, don't abandon a good company the moment the price falls. The right response depends on the story behind the stock. If a stalwart has doubled and nothing fundamental has changed to justify more upside, sell some or all and redeploy into another stalwart whose story is intact. If 2 fast growers are in your portfolio and one price rockets ahead while its expansion stalls, rotate into the other whose story is still accelerating. That way you're always investing where the fundamentals and valuation line up. Avoid mechanical rules that substitute price for research. Lynch is emphatic that stop orders and fixed sell rules, sell at a 10% loss or sell when it doubles, are generally counterproductive. Stops tend to sell you out at temporary lows, and mechanical sell at a double rules make you miss multi-decade winners. Instead of relying on price triggers, ask, has the company's story changed? Did earnings guidance, competitive position, debt structure, or management behavior shift? Sell when the story changes, not when the price moves. Lynch gives cautionary examples from his own career. He mentions Electronic Data Systems, a company with extraordinary hype and dizzying price-to-earnings ratios in its heyday, which fell catastrophically when expectations outstripped reality. He also talks about Texas Air, where the story improved, then worsened, then improved again. He admits he should have been quicker to rotate out when the fundamentals deteriorated. These examples show that no one is immune to mistakes, but the disciplined practice of checking the story and rotating positions makes it likelier you'll profit from your winners and limit losses from the losers. The bottom line is straightforward. Do the homework, keep the number of positions to a manageable level, spread across categories that suit your temperament, and rotate based on fundamental developments rather than daily price noise. Be patient. Lynch's recurring message is that the compound rewards of owning great businesses and staying invested will outpace frantic trading. If you adopt a thoughtful plan, respect costs, and sell only when the story changes, you stand a good chance of beating the market over the long run and of enjoying the process along the way.